So in this video, I'm going to go through 3 sort of outside the box or non-traditional ways of financing that require really no money as a down payment or very little money as a down payment. So you can start doing this even if you're not sitting on a mountain of cash in your bank account. Hey, I'm Kirby Atwell from Living Off Rentals. And although interest rates have crept up recently, it's not the sky is falling scenario that a lot of people make it out to be. There's still lots of options available to finance your property, even if it's slightly more expensive than it used to be. So these are 3 of my favorite ways to fund investment properties and how I financed probably 90% of the properties that I've purchased over the last few years, including this Airbnb investment property that I'm sitting in that I bought last January. Number 1 is the combination of a DSCR loan or a debt service coverage ratio loan with private money. Now I know that sounds a little complicated, so let me break down exactly how this works. Back in 2011, when I was first getting started in real estate investing, DSCR loans just didn't exist. I wish they did, because one of the drivers for me getting into flipping initially was the fact that I couldn't get financing for something that I wanted to buy and hold on to for the long term. So I started flipping properties. At the time, if you wanted to buy and hold on to something, all that was available really was these conventional investment loans, which were still based on your W-2 income. Over the last 3-4 years, DSCR loans have become really popular, especially as interest rates have come down. And what DSCR stands for is debt service coverage ratio, which means that the income from the property, the rent payment on a monthly basis, exceeds your debt payment. So your principal, interest, taxes, and insurance. That's your mortgage payment that you're gonna. So if you're making $1,000 a month in rent or from Airbnb from your guests, is it more than your mortgage payment? So is your mortgage payment $1,000 or less? And if it is, most of the time you're going to qualify for a DSCR loan. So they're not looking at your W-2 payment or your W-2 income. They're not looking at your bank statement. They're not looking at your assets personally. They will most likely pull your credit score just to make sure you don't have a history of defaulting on loan payments. But beyond that, it's purely based on the asset itself. So that's one thing to keep in mind. Many of the terms are similar to a conventional type of loan. So a fixed 30-year rate, usually just above a conventional type of rate. So this is one option for buying investment properties. You can buy these over and over again. There's not a cap like there are on Fannie or Freddie type conventional loans where you can max out at 10 of them. You can buy as many of these as you want. But I know what you're saying. Yeah. But with the DSCR loan, you still have a down payment. Got it. So that's why I said combine a DSCR loan with private money. So there's lots of people out there in your network, and you'd be surprised to find out who they are because people don't go around with their bank account balance listed on their forehead, but there's lots of people out there who would love to make a 10% fixed return on their money. Pull it out of the stock market that's already appreciated leaps and bounds over the last several years and invest it in a secure asset that you're buying under market value that is backing their investment. And those are called private lenders. That's really just purely what a private lender is just somebody who wants to make a fixed return on their investment. So now you can combine these 2 types of loans together and you can purchase an investment property without a single penny out of your own pocket. This is how it works. You take out a DSCR loan from an investment type lender, and there are lots of investment type lenders out there. I'll post the link below in the description to a couple I've used in the past. I'm not endorsing any of them. They've just done well by me, and they've financed pretty much all of my short-term rentals, all of my investment properties, which are all short-term rentals. They've done the loans on those. The typical terms for a DSCR loan is about 75 to 80% financing. So you're gonna have to come to the table with 20 to 25% down payment. So that's where the private lender comes in. So now you have conversations with private lenders and it's not a pitch.
Derek, for your birthday, we thought we'd roll out a once-in-a-lifetime business opportunity. Investors? Possibly you!
Oh, this is classic.
Not like that. This is more of an opportunity that you're providing to mostly friends and family type people. And it just comes from sharing what you're doing. People way overcomplicate this. So whether you've done deals in the past or you've never done a deal, what I recommend is just creating a 1 to 2 page document that just outlines what you're targeting, the type of deal that you're targeting, what type of returns you're expecting on the deal, how much you're going to put into it, and then what you're going to offer the private lender as well. And if you're offering double-digit fixed returns, that's extremely attractive to a potential investor who's looking for some place to put their money, especially if it's not on some like harebrained startup idea, but it's on an asset that's underlying their investment. So if you decide to run off to Mexico, they get this property that you've just bought under market value, and they're no worse for the wear. This is how I funded the vast majority of my investment properties. The DSCR loan is in first position at a low fixed interest rate, and then the private lender comes in at a slightly higher interest rate in second position, and they cover things like the down payment, any rehab that I need to put into the property, and things like the furnishings for my Airbnb investments. So I have $0 out of pocket, and the combined payment on the two different loans is still low enough when you put it on Airbnb that you can still cash flow in a lot of cases really, really well without any down payment out of your own pocket. The second outside the box type of financing option that requires no money out of your pocket in some cases that I really like, that I've done several of in the past, is to form a joint venture with another investor. A lot of people have preconceived notions around what a joint venture constitutes. And really, all it is an agreement, and it can be as simple as a 1-page document that outlines who's doing what when it comes to an investment type. So think about what your skill set is. So if you don't have any financing, you don't have any money that you can bring to the table, then maybe you have the ability to find deals, or maybe you have the ability to rehab properties, or you have some other skill set that you could bring value to an investor who might have the money, but they don't have the time, or they don't have the ability to go out and find deals. So if you can find someone who's done some deals, most likely they have access to funding. And in today's environment, it's very difficult to find deals. So you can approach them and say, hey, I know you have the funding lined up. I'll go out and find us a deal. We'll come together and we can joint venture on this particular project and then come up with some split of the proceeds. Like I mentioned, a joint venture is typically controlled by a joint venture agreement. And this does not have to be a complicated document. What I recommend is just bullet pointing out all the terms of the agreement. So it doesn't have to be a 50-50 split. You can split it up based on the contribution that each party is bringing to the joint venture. Then I recommend spelling out who's responsible for what, what each party is doing as a part of this particular deal. And then what happens if? What happens if we have to sell for a loss? What happens if one person dies? All those types of things. So you can take all these bullet points then and hand them to an attorney, and they can pretty simply turn it into a legal document, and that controls the joint venture. So this is option number 2 for outside the box financing of an investment property. The third somewhat outside the box method of financing an investment property is the old Bur method, but with a slight twist. My recommendation, if you don't have a big down payment to put toward an investment property, is to target a fixer-upper and do the Bur method, where you're buying, rehabbing, renting, refinancing, and repeating, but doing it on a very affordable property. If you haven't seen my last video on how I bought a $26,000 property that brings in over $10,000 in income in some months, first off, shame on you. But you can check it out at the interactive link that just popped up at the top of the screen. I think it's a good frame of reference for this example. So it's very common for people who are doing these BRRRR type investment deals to use hard money up front to fund the purchase and rehab of the property before they refinance it into long-term capital. Hard money is just the term for another very common type of investment loan. And these are designed for the purchase and rehab of investment type properties. So typical terms on these is that the lender will fund somewhere between 80 to up to 90, sometimes even 100% of the purchase, but it's typical to see about 90% of the purchase price, and they'll fund 100% of the rehab in a lot of cases. Now, the way they protect themselves is they hold back the rehab at closing, and they release that as the property is being rehabbed so they don't get overextended. So if you think about it, if you bought a very affordable property with a low purchase price but maybe has a high rehab amount, you can get a lot more money than if you're buying something that's got a high purchase price and a very low rehab amount, because you're going to have to come up with the down payment on the purchase price, not necessarily on the rehab amount. So let's just say in my previous example where I bought a property for $26,000 and then I put another $80,000 to $100,000 into the rehab. A hard money lender would give me, in a lot of cases, 90% of the purchase price and then 100% of the rehab. So I would have to come up with a very small down payment. If it's 10%, that's $2,600. It's pretty easy to save up $2,600 for a down payment on the purchase price of a $26,000 property and then let the lender cover the rehab amount. And then once you're all done, you can refinance this property at its new value after it's been rehabbed into a 30-year DSCR type loan, like I just talked about in the first example. And in a lot of cases, you can pull out all or close to all of your upfront funding, and so you have no money into that deal. So those are the three types of outside the box financing that I would recommend if you don't have stacks and stacks and stacks on stacks on stacks of cash. However, there's a bonus method for financing, and I cannot not talk about this method, and it applies to you if you are somebody who's just getting into buying real estate for the first time, whether it's an investment property or it's your primary residence. This is by far the most impactful way to invest in real estate, but it's only for people who are just getting into this, because you have at your disposal a way to buy at the absolute lowest interest rate, fixed interest rate, and this is across real estate and any other type of investment. This is the lowest, best type of financing terms that you're ever going to come across. And that is either the VA loan, if you're a veteran like I am, or an FHA loan. The terms on both of these types of loans mirror each other, are very similar to each other, and both require an extremely low down payment. The VA loan is 100% financing, so you literally have to have no down payment at all. In some cases, they actually pay you at closing because you get tax credits back from the seller, and you actually walk out with a check and a house at the same time. And with FHA, typically it's about 3% down or 3.5% down. So you can buy a primary residence, you can buy your first property as a primary residence, but just make it a multi-unit property. And that doesn't have to be like a traditional apartment type property where it's a traditional 2 to 4 unit looking property. You can buy a house that has a pool house in the back that you convert into a cool Airbnb. You can buy something that has a basement that's unfinished that you can turn into an Airbnb. Or you can buy something with a garage, or you can get as creative as you want and use this 100% financing or almost 100% financing to buy something that's going to offset your cost of living, which is typically the biggest cost in anyone's personal finance budget. And a lot of times it will pay you on top of that. So that's the bonus method. Obviously, it's not going to apply to everyone, but if you haven't used those types of financing before, that's the best place to start. If you've made it this far with me, I appreciate you. And if you want more information or want to learn how to get started with vacation rentals specifically, you can go to livingoffrentals.com/start. I have a masterclass there that will walk you through the process of getting started with buying your own vacation rentals. I hope to see you there, but if not, I'll see you in the next video.